performance appraisal, working capital analysis. Management of working capital involves a compromise between meeting the goals of financial management and those of sales, credit control, and operations management. In this session, we are going to look at the crucial difference in terms of financing and balance sheet structure between firms with net current assets and those with net current liabilities, and how they're each affected by growth. We will also take a close look at the operating cycle and at metrics we can apply to work out how fast a company turns out over its stock, how quickly its customers pay for their goods, and how quickly the company pays its suppliers. We'll also look at how to interpret changes in these metrics, make reasonable inferences about the causes of the changes in their values, and identify possible risks to the firm arising from such changes. So session aims more formally. In this session, you will learn about working capital financing issues and goals, key activity metrics for inventory, accounts receivable, and accounts payable, interpretation of activity metric changes, and operational constraints on financial goals and trade-offs. And as usual, a detailed list of intended learning outcomes for the session. And just to recap, working capital concerns trading assets and liabilities of the firm and is defined as current assets minus current liabilities. And there that's shown it graphically, with current assets being greater than current liabilities. The current ratio is a key financing metric, and this is defined as current assets divided by current liabilities. The current ratio may be greater or less than 1, depending upon the nature of the firm's business. It indicates whether the working capital operations require financing or is a source of financing for the firm's non-current assets. If the current ratio is greater than +1, it means that current assets are greater than current liabilities, so it's otherwise known as net current assets. And the value shows the number of times that current assets exceeds current liabilities. If it's greater than 1, it means that working capital requires long-term financing from equity and non-current liabilities. Manufacturers, for example, often have lengthy lead times between buying raw materials and components and producing the finished goods. They tend to have relatively high inventory levels and turn their inventory over relatively slowly. They also sell to corporate customers who buy on credit, so accounts receivable is also much higher than it is for retailers. Accounts payable is usually much lower than inventory plus accounts receivable, and hence manufacturers' current assets are usually greater than the current liabilities, and the current ratio greater than 1. And these firms require long-term financing to fund their working capital because they have to pay their suppliers before they receive payment from their customers. Alternatively, for companies where the current ratio is less than 1, current liabilities are greater than current assets, so this otherwise known as net current liabilities, and the value shows the proportion of current liabilities being used to fund current assets, and this is a source of funding for the firm's non-current assets. Firms such as retailers have cash sales, buy the goods that they sell from their suppliers on credit, and have rapid turnover on stock, and they usually have a current ratio less than 1. Most of these firms have accounts payable that are significantly greater than the sum of their inventory and stock and accounts receivable. Most supermarkets benefit from cash sales and lengthy payment terms with suppliers. They receive the cash from sales before they have to pay their suppliers. And this is in part due to most of the power in the relationship between large retailers, for example, Walmart, Carrefour, Tesco's, and their suppliers rest with the retailer. The retailers are larger than their suppliers. They control access to the end customer. They have eliminated many independent retailers, and suppliers have little choice other than to sell through their stores. Retailing has become highly concentrated, while suppliers are often much smaller and their industry is fragmented. UK supermarkets, for example, are able to impose credit terms on their suppliers, typically from 60 to 90 days. And moving on to growth and structure. So when the current ratio is greater than 1, working capital borrowing requirements increase with sales. So growing companies with a current ratio above 1 need to keep relatively high levels of cash because they tend to pay their suppliers before they receive payment from customers. And as sales grow, their need for cash increases. And they typically need to issue either more long-term debt or retain more equity as the firm grows. and this is quite different to firms where with net current liabilities where the current ratio is less than 1, where working capital is a source of financing for non-current assets. In these cases, the growth in working capital with sales provides new financing for a firm's non-current assets. One of the most useful ways to look at working capital elements is in terms of how long it takes a firm to turn its stock over, pay its supplier, and get payment from its customers. This can be expressed as an annual turnover rate, or it can be expressed as a number of days, which is what we're going to do. So we'll start off with days purchasing outstanding. This concerns money the firm owes for goods and services it has received. So the account it concerns is accounts payable. This is a source of financing for the firm, also known as supplier credit, generally free. Inventory days. Inventory days concerns the length of time it takes a firm to turn its inventory over. So it concerns money tied up in raw materials, work in progress, and finished goods. And inventory has to be financed. So the more inventory, the greater the financing requirements. And finally, days sales outstanding. So the other side to days purchasing outstanding. This is money owed for goods and services that the firm has sold to its customers. So this concerns accounts receivable, and it is the company providing finance to customers. And let's look at how to define these. So days sales outstanding is equal to accounts receivable divided by revenue times 365. The form of these equations is always the same. So the numerator is the balance sheet item, the item from the income statement is the denominator, and what this shows is the number of days of sales where the invoices are still outstanding, so that cash has not been collected from the customers for services that have been delivered at the year end. Or alternatively, we can express this as the average number of days it takes customers to pay for their goods. Moving on, days purchase outstanding is equal to accounts payable, and this is divided by cost of purchases times 365. And this shows the number of days of purchases where the invoices are still outstanding, so the firm has not yet paid them at the year end. Or we can also express this as the average number of days it takes the firm to pay their suppliers. Unfortunately, companies are not required to disclose cost of purchases, and cost of sales, the value for cost of sales is often used as a substitute for cost of purchases when the purchase number is not available. Using cost of sales rather than cost of purchases tends to understate the value for days of purchases outstanding. And finally, inventory days. So inventory days defined as inventory divided by cost of sales in this case times 365, and this measures the proportion of purchases where the goods are still in inventory at the year end. It expresses a number of days, or alternatively, the average length of time that stock stays in inventory. Now, all of these three activity metrics assume a smooth flow of goods and cash throughout the year. We could use average balances, but for the sake of this course, I'm going to keep it simple and just use year-end balances. But seasonal sales will distort these measures for firms which have a seasonal nature. And another measure, cash conversion cycle days. And this measures the number of days between the firm paying its suppliers and receiving cash from its customers. So it's defined as days inventory outstanding, which is an asset, plus days sales outstanding, which is the other asset item, minus days purchasing outstanding, which is the liability. The number varies by industry, of course. It depends upon the strength of the power relationship between the firm, its suppliers, and its customers, and the nature of its inventory. The shorter the cycle, the smaller this number is positive, the less money is tied up in working capital. So it's an alternative way of looking at the relationship between current asset and current liabilities. When this number is negative, which will generally be the case for a firm with a current ratio less than 1, it represents the number of days between receiving cash from customers and subsequently having to then pay the firm's suppliers. Management of working capital is about trade-offs, and it has 4 key dimensions. liquidity, financing, operational efficiency, and relationship with customers. Let's look at those each individually. So start with financing. If a company has a current ratio which is greater than 1, so current assets greater than current liabilities, working capital has to be financed. And the goal in this case is to keep that funding requirement as low as possible. So keeping working capital as low as possible. On the other hand, if the current ratio is less than 1 and working capital is a source of funding for the rest of the business, then the goal is to maximize the amount of funding available for the other parts of the business, so as to increase net current liabilities. We've also got liquidity, the need to hold enough cash to be able to make all payments due to suppliers, employees, other creditors such as tax authorities and debt holders at the time they're due, while keeping this as low as possible because of low returns on cash. And if we think about operational efficiency, on the one hand, to meet the low financing goals, we want to keep it as low inventory as possible. There's also a need to buy in bulk to try to get volume discounts, and also a need to keep sufficient inventory to ensure that the firm is able to operate efficiently, that the production process is not disrupted, and that when it comes to sales, that it can meet demand from customers in a timely manner. And lastly, the relationships between managers and between customers and suppliers. This is very much driven by where the power is in this relationship, and the need to manage the relationship between customers and suppliers effectively. And so the main challenge of managing working capital effectively comes from having to balance these conflicting goals. And we can see this in the case of inventory. So from the goal of low financing costs, the firm should keep its inventory as low as possible in order to minimize financing costs, but this has to be balanced against operational efficiencies and meeting customer demand. So high operational efficiency would favor keeping higher levels of inventory, and this also would allow the firm to obtain volume discounts by buying in bulk and ensure the operation can cope with interruptions to supply due to supplier or transportation problems. And keeping high inventory levels helps good customer relations. Being able to meet unexpected demand from customers would also favor higher levels. And if the firm is unable to fulfill orders in a timely way, it risks losing the order to a competitor who can do so, and then in the longer term, potentially losing the customer's business for good. And in terms of the relationship with the suppliers, the more stock a firm holds, the greater the amount of credit and discounts the firm will want from its suppliers. Firms with high buyer power may be able to impose such terms, but at the expense of the supplier relationship. Irrespective of whether a company has a current ratio greater than or less than 1, these are the sorts of things which companies need to do in terms of the key components of working capital to meet the financing goal of minimizing the amount of funding and the associated risks or trade-offs from doing so. So in terms of cash, we want to keep as low a level of cash as possible, and what cash we do have to get a decent return from deposits, which favors less liquid deposits. But the risk here is that if you don't keep enough cash or keep it in too illiquid a form, that the firm fails to meet its contractual payments or has to get expensive overdrafts, and we'll look at the consequences of missing payments in a moment. If we look at inventory, so the financing goal would have us keeping this as low as possible and turnover as high as possible. The risk of this approach is that we run out of inventory, causing expensive production delays or lost sales. And in terms of accounts receivable, which is providing supplier credit to the customers, from a financing point of view, we will want to reduce payment terms to customers and get customers to pay faster. We'll look at factoring receivables in due course. But the risk here is that the company loses sales, and because customers cannot finance the purchase from cash, or they can get better terms from competitors. And finally, accounts payable. So this is where the firm is getting credit from suppliers. The goal here from a financing point of view would be to keep this as high as possible and pay the suppliers as slowly as possible. But the suppliers may not agree to, and the risk here is that if the company enforces these terms on suppliers, that they may go out of business. And the ability of the firm to impose terms on suppliers really depends upon where the power lies between the suppliers and the company. Let's move on and talk about some penalties for late payments. So in terms of late payments to suppliers, there may be penalty charges in the contracts, and there's also a risk that if a firm continually pays its supplier later than contractually due, that the supplier will simply refuse to deal with the firm in future. And paying tax authorities late in terms of tax due, tax authorities will impose punitive penalties far in excess of the amount of tax which is actually at stake. And if we talk about lenders and bondholders, that there may well be penalty charges, but probably more importantly, any late payments to these guys will adversely affect the firm's credit rating, and this will affect future borrowings. It will affect the ease with which the firm can borrow in the future, and the cost of such borrowing, the rate it will have to pay for new financing. And there's also the final risk is that of legal action. If it makes late payments to creditors, then the creditors may take action through the courts, in which case there is the threat of the seizure of assets and eventually the threat of bankruptcy and liquidation if the firm is unable to pay what it owes on time, even though the firm may be solvent from an accounting perspective. So cash and overdrafts. Generally speaking, investors do not like firms to hold large amounts of cash and cash equivalents. And there's a few reasons for this. The first is that if investors do have cash, they can invest it easily themselves in money market products. They don't need to give it to pay managers of the firm to do that for them. Investors want firms to invest the cash which has been invested in them in productive assets rather than having it sit idly in the company's bank accounts. There's also a risk that if a company has too much cash, that they make ill-judged acquisitions with that excess cash. But on the other hand, if they run out of cash, overdrafts, which is an unarranged form of short-term financing from a bank, are relatively expensive. Factoring is another method of raising cash for short-term uses, which involves selling accounts receivable to banks. And we'll look at that next. So accounts receivable and factoring. This is part of a firm's cash management tools, and it's most useful for firms with highly seasonable or erratic cash flows, because it can be an expensive way of raising funds in the short term. But it does provide a way to get payment on outstanding customer invoices faster than the contractual date. And in brief, the invoices from accounts receivable are sold on to a bank or a financial institution which specialises in buying accounts receivable, and they are bought at a discount to the face value. And this process is called factoring. Let's look at this in a diagram. The bank takes on all of the credit and collection risk from the invoices which have been sold on, if the company that is selling them is to remove them from their accounts receivable. So it's a sale without recourse. Let's look at the structure of accounts receivable and factoring. So we start off with the company sells goods to customers and it invoices the customer for those goods. And the terms might be 90 days. If the company needs to get cash faster than that, what it can do is it can establish a relationship with a bank, otherwise known as the factor, a financial institution which specialises in this sort of financing, and the company will sell on outstanding company invoices. So if we take an example of an invoice with a face value of £100, and this is £100 which the customer is due to pay in say 90 days time, the bank will pay a discount to this face value, for example £98, and the difference between the £100 face value that it will receive in £100 in 90 days and the £98 it's paying is to account for the interest on the financing and also for the potential bad debt losses on customers defaulting on the payments. And if everything goes well, 90 days later the customer will pay £100 and that will go directly to the bank, which effectively pays off the loan that the company has taken from the company has effectively taken from the bank. Let's move on to inventory days. So if we see the value for inventory days increasing, then the first thing is that the company is stockpiling. The amount of inventory relative to its sales is increasing. And there's a number of possible explanations. So the most likely explanation is that sales are lower than expected. This is the most likely explanation most of the time, but it's not the only possible explanation. Alternatively, if it is a seasonal business, there might be a stock building in preparation for a run up to a sales period. But this is unlikely to be an explanation if the increase in inventory days is on a year-on-year basis. It would be an explanation on a quarter-on-quarter basis at seasonality. Other possibilities to explain stockpiling would be that the firm is anticipating shortages or anticipating a supply disruption or indeed anticipating a potential future price increase and is buying in now to avoid the shortage or the supply disruption or the price increase at a later date. If on the other hand inventory days is falling, it means that inventory is being run down. And again, there's a number of possible explanations. The first is that perhaps sales were better than the company had expected. There may be a better new stock control system has been introduced so that just in time the stock management is better, or it is simply after the event reduction in an unwanted stock buildup, or it could be problems with suppliers or shortages more generally, and those are problems outside of the firm's control. More worryingly would be that the suppliers are not delivering to this particular firm, and this could be due to the firm having problems paying for this. Move on to days sales outstanding. So if this is increasing, it means the customers are paying at a slower rate, and it could be that customers are finding it generally difficult to pay invoices on time. Perhaps the economy has entered into a recession, and if that's the case, there's a risk that bad debt losses are rising, and an easy way to check that is to see whether impairment allowances as a percentage of receivables have been increasing. Alternatively, and more benignly, the company may have changed payment terms to give customers longer to pay. Accounts receivable is a way to give supplier credit to customers, and this is free financing. It is a form of price discounting to increase sales, but the longer you give customers to pay, the higher the credit risk. So such action to increase sales is at the expense of high credit risk. Alternatively, they're falling. Customers generally do not choose to pay at a faster rate than they are contractually due to. They will tend to pay at or around the last day that they can to minimize their own financing requirements. So there's a number of possible. The most likely is that the company has tightened payment terms. And then the question would be, why has it tightened them? Is it because it sees problems with specific customers or industry segments? Is it anticipating a downturn or recession, in which case bad debt losses will grow? And the shorter the payment terms, the less likely that this particular company will be to take those losses. And we'll look at days purchase outstanding. So if they're increasing, it means the company is paying its invoices slower. So a question to ask is the company finding it difficult to pay invoices on time? Is the company in some form of financial distress? Alternatively, the company may have been given better terms by its suppliers to incentivize it to buy more. And it's a form of price discounting to increase sales, but at the expense of higher credit risk at the supplier. Or it may be that the company has imposed this on suppliers where all of the power lies with the supplier. If days purchase outstanding is falling, this means that the company is paying its invoices faster. Could it be that the company's financial position is improving and it's able to now pay its invoices on time? Or more likely, has the supplier tightened payment terms so that the company has less time in which to pay for its goods? So we've looked at some working capital issues and goals, introduced key activity metrics for inventory, accounts receivable, and accounts payable, talked about some of the interpretation of activity metric changes, and some of the operational constraints on financial goals and trade-offs.